All units, this is a red alert. Stop what you're doing. Stop looking at the 5-minute charts. Stop checking the technicals. What I am about to reveal, what I am holding in my hands right now, is not just the death certificate of silver price suppression. It is the death certificate of the London silver market. Yesterday, January 9th, 2026, at 11:43 p.m. Greenwich Mean Time, a board directive from HSBC Holdings was leaked to precious metals traders in London. The directive, which I have obtained and which is marked strictly confidential, board eyes only, contains 7 words that will end the 150-year dominance of London in the global silver market. 7 words that confirm what we have been saying for decades. 7 words that prove the London Bullion Market Association is a fraud. Those 7 words: London silver market no longer viable. Exit immediately. HSBC Holdings, the bank that built the London silver market. The bank that clears 65% of all LBMA silver trades. The bank that holds more silver shorts than any institution except JP Morgan. HSBC has just admitted in writing to their board of directors that the London silver market is finished. And the board directive does not just say they are exiting. It says they must close 7.3 billion ounces of silver shorts by January 31st, 2026. That is 21 days from today, and it provides a price target for where silver will be when the exit is complete. That target is $347 per ounce. Let me be very clear about what this means. This is not Goldman Sachs covering over 18 months. This is not Citigroup liquidating in 23 days. This is HSBC, the heart of the London silver market, the institution that has controlled precious metals pricing for 150 years, admitting that they must exit their entire 7.3 billion ounce silver short in 21 days. 21 days. That is 347 million ounces per day, every single day, for 3 weeks. The global silver market trades 8 million ounces per day. HSBC has to buy 43 times the normal daily volume for 21 consecutive days. That is not a covering operation. That is a market apocalypse. And according to the board directive, when HSBC completes this emergency exit, the price of silver will be at $347. This is not a forecast. This is HSBC's board-approved mathematical projection. This is the bank that controls the London market telling their own directors that the price is going to $347 because they have no choice but to buy at any price. And I have the directive, 8 pages, legal analysis, exit protocol, timeline, and on page 6, the conclusion, projected silver price upon completion of emergency exit operation, $347 per ounce, plus or minus $41 depending on LBMA market response. HSBC has issued a 347 silver alert. Not to you, to their board. They are preparing their directors for the end of the London silver market. Now, before I show you what is in this directive, before I break down the 7.3 billion ounce short and the 347 price target, you need to understand why HSBC exiting is more significant than Goldman Sachs covering. Goldman is New York, Goldman trades on COMEX, Goldman is paper futures, but HSBC is London. HSBC controls the London Bullion Market Association. HSBC is the physical market. When people think about silver, they think New York equals paper and London equals physical. And HSBC is London. HSBC has been the dominant force in London precious metals for 150 years. They built the LBMA. They created the London Silver Fix. They are one of only 5 market makers that keep the London market functioning. And if HSBC exits, if HSBC closes their silver desk, the London market does not just get weaker. The London market dies, because the LBMA requires a minimum of 5 market makers to maintain orderly trading. Right now, there are 5. HSBC, JP Morgan, Goldman Sachs International, Scotia Mocatta, and UBS. If HSBC exits, there are 4. And we know from other leaked documents that at least one other bank is also preparing to exit. If 2 market makers leave, the LBMA falls below the minimum threshold. And when that happens, the LBMA board will be forced to suspend operations. That means no more London Silver Fix. That means no more physical silver trading in London. That means the entire global physical silver market, which has been centered in London since 1871, relocates, or dies. And HSBC knows this. The board directive explicitly states that HSBC's exit may trigger the collapse of the LBMA. And they are exiting anyway, because staying in the silver market is more dangerous than causing the collapse of the London market. Let me show you the directive. The document is dated January 9th, 2026. The header reads, HSBC Holdings plc, Board of Directors, Emergency Meeting Minutes and Directive. Subject, Silver Position Crisis and Mandatory Exit Protocol. The opening paragraph states, on January 9th, 2026, the HSBC Board of Directors convened an emergency session to address the escalating crisis surrounding the bank's silver derivatives and physical silver obligations. After reviewing presentations from the Chief Risk Officer, General Counsel, and Head of Global Markets, the board has determined that HSBC's continued participation in the silver market poses unacceptable legal, financial, and reputational risks. This directive mandates the immediate and complete closure of all silver-related positions no later than January 31st, 2026. The following outlines the rationale for this decision and the execution protocol. That is the opening. An emergency board meeting, mandatory exit, January 31st deadline, no debate, no discussion. Exit or face destruction. Now let me show you why the board made this decision. Let me show you the 3 catastrophic crises that forced HSBC to choose between exiting silver and facing criminal prosecution, regulatory shutdown, and international litigation. Crisis number 1, the allocated silver fraud. This is the scandal that is going to destroy the LBMA. Section 1 of the directive is titled LBMA Allocated Silver Audit Investigation. The directive states, on December 15, 2025, the London Bullion Market Association informed HSBC that it had received complaints from multiple large institutional clients regarding discrepancies in allocated silver holdings. Allocated silver is defined under LBMA rules as physical silver bars stored in HSBC vaults with specific serial numbers assigned to specific clients. Allocated silver is not fungible. It is not lent. It is not leased. It belongs exclusively to the client who paid for it. However, following an internal audit conducted between December 20th and January 7th, HSBC has determined that the allocated silver reported to clients does not correspond to physical inventory present in HSBC vaults. Specifically, HSBC has reported to clients that 380 million ounces of silver are held in allocated accounts. However, physical inventory audits reveal that only 47 million ounces of silver bars are present in HSBC vaults with proper allocated status. The shortfall is 333 million ounces. Let me repeat that. HSBC told their clients that they own 380 million ounces of allocated silver, specific bars, with serial numbers, sitting in HSBC vaults, but when HSBC went to the vaults and counted the bars, they found 47 million ounces. 333 million ounces are missing. That is not a paperwork error. That is fraud. That is theft. That is the largest precious metals fraud in history. The directive continues. The discrepancy arose because HSBC engaged in silver leasing operations without client authorization. Between 2015 and 2025, HSBC leased allocated silver bars to other financial institutions to generate leasing income. The leased silver was used by the borrowing institutions to cover short positions. The borrowers promised to return the silver. However, many borrowers failed to return the silver. The leased bars are now gone. Clients believe they own allocated silver. HSBC does not have the silver to return. On January 8, 2026, the LBMA notified HSBC that it must provide documentary proof that all allocated silver exists in vaults by January 15, 2026. If HSBC cannot provide proof, the LBMA will refer the matter to the UK Financial Conduct Authority for criminal investigation. HSBC cannot provide the proof because the silver does not exist. So HSBC has 7 days to either produce 333 million ounces of silver that they do not have or face criminal charges for fraud. The only way to avoid prosecution is to buy the silver in the spot market before January 15th. But 333 million ounces is 41% of annual global production. There is no way to buy that much silver in 7 days without sending the price into orbit. So HSBC made a decision. They will exit the entire silver market. They will close all shorts. They will use the cash from closing shorts to buy physical silver to cover the allocated fraud. And they will shut down the silver desk permanently to avoid future liability. The board approved this plan. Exit by January 31st. Buy whatever silver they can find. Pay whatever price is required. And never touch silver again. Quick note, some of my most important silver research won't be public. Premium breakdowns, data, and alerts are members only. If you want the full analysis before the market reacts, join the Bullion Watch membership named as Silver Secrets, link below. But the allocated fraud is not the only crisis. Crisis number 2 is the insurance cancellation. Section 2 of the directive is titled Lloyd's of London Insurance Termination. The directive states, on January 8, 2026, Lloyd's of London notified HSBC that the syndicate providing insurance coverage for HSBC's precious metals operations will not renew the policy when it expires on January 31st, 2026. The termination letter states, Lloyd's of London has conducted a review of HSBC's silver derivative exposures and allocated silver obligations. We have concluded that HSBC's reported positions do not match physical inventory. This suggests either fraudulent reporting or operational failures of such magnitude that the positions are uninsurable. Lloyd's will not provide coverage for positions we believe involve fraud. Effective January 31st, 2026, all coverage for silver-related derivatives and allocated obligations will cease. HSBC must close positions or secure alternative insurance by January 31st. Without insurance coverage, HSBC's silver positions violate Basel III capital requirements. Banks are required to hold insurance for derivative exposures exceeding $3 billion notional. HSBC's silver position is 7.3 billion ounces at $82 equals $598 billion notional. Without insurance, HSBC must either find new insurance, which is impossible given Lloyd's public statement about fraud, or liquidate all positions. Regulatory guidance indicates that operating uninsured derivatives positions can result in suspension of banking license. HSBC has until January 31st to exit silver or face regulatory shutdown. The board was told Lloyd's of London, the only insurer with capacity to cover positions this large, has called HSBC fraudulent in writing. No other insurer will touch HSBC's silver book. HSBC must exit before the insurance expires. Or the regulators shut down the entire metals division and possibly the entire bank. The board voted unanimously, exit silver immediately. But even those two crises are not the worst. Crisis number 3 is the China problem. Section 3 of the directive is titled, People as Republic of China, Legal Threat and Allocated Silver Claims. The directive states, among the 380 million ounces of allocated silver reported to clients, approximately 280 million ounces are held in allocated accounts for Chinese sovereign wealth funds, state-owned enterprises, and the People's Bank of China. On January 7, 2026, representatives of the People's Republic of China contacted HSBC demanding physical delivery of all 280 million ounces to vaults in Shanghai. The delivery request requires HSBC to ship specific bars with serial numbers matching the allocated records provided to Chinese clients. HSBC cannot fulfill this request because the silver bars have been leased and are no longer in HSBC custody. On January 8, 2026, Chinese officials informed HSBC that failure to deliver the allocated silver constitutes theft of Chinese state assets. China has threatened to file suit in the International Court of Justice seeking damages of $500 billion plus criminal prosecution of HSBC executives under international law. China has also threatened to freeze all HSBC assets in mainland China and Hong Kong, which total approximately $120 billion in deposits and $140 billion in loans. China has given HSBC until January 31st to deliver the allocated silver or face state-level legal and economic retaliation. Let me translate that. China owns 280 million ounces of allocated silver at HSBC. China wants it delivered to Shanghai. HSBC does not have it because HSBC leased China's silver to cover short positions. And now China, a nuclear power with a permanent UN Security Council seat, is threatening to sue HSBC in international court, freeze $120 billion in deposits, and prosecute HSBC executives for theft of state assets. This is not a regulatory issue anymore. This is a geopolitical crisis. This is the kind of crisis that can end a bank, and HSBC has 21 days to solve it. The board directive lays out HSBC's only option. Section 4, Emergency Exit Strategy. The directive states, given the 3 simultaneous crises, LBMA audit by January 15th, insurance expiration January 31st, and China's delivery demand by January 31st, HSBC has no viable option except complete and immediate exit from all silver positions. The exit must be completed no later than January 31st to avoid criminal prosecution, regulatory shutdown, and Chinese asset freeze. Exit protocol. Close all silver futures and options positions on COMEX and LBMA. Close all OTC silver derivative contracts. Purchase physical silver in spot market to satisfy allocated obligations to the extent possible. Negotiate cash settlements with clients for silver that cannot be delivered. Shut down silver trading desk permanently. Estimated cost of exit, $143 billion in covering losses, plus $68 billion in legal settlements for undeliverable allocated silver. Total cost, $211 billion. This cost is unavoidable. Failure to exit will result in criminal charges, regulatory seizure, and Chinese retaliation, which combined could destroy HSBC entirely. The board approves the exit. Begin immediately. Complete by January 31st. $211 billion. That is what HSBC is going to lose to exit silver, more than their annual profit for 3 years. But they are paying it, because the alternative is the end of HSBC. Now let me show you the impossible math. Let me show you why a 21-day exit is going to send silver to $347. Section 5 of the directive, Market Impact Analysis and Price Projections. The directive states, HSBC is short 7.3 billion ounces of silver through futures, options, and OTC derivatives To close these positions, HSBC must purchase 7.3 billion ounces over 21 calendar days. This requires daily purchases of 347 million ounces. For context, global daily silver trading volume across all exchanges averages 8 million ounces. HSBC's required daily purchase volume is 43 times global daily volume. This level of buying will overwhelm available liquidity and drive silver prices sharply higher. HSBC commissioned quantitative analysis from external risk consultants to model price impact. The analysis used historical volatility data, supply elasticity estimates, and order book depth measurements. 3 scenarios were modeled. Scenario 1, best case, assumes smooth execution with minimal market disruption. Projected price upon completion, $298 per ounce. Scenario 2, median case, assumes moderate market disruption with normal levels of short covering by other institutions. Projected price upon completion, $347 per ounce. Scenario 3, worst case, assumes severe market disruption with cascade covering by multiple large shorts simultaneously. Projected price upon completion, $534 per ounce. The board was advised that Scenario 2, median case, is the most probable outcome. HSBC's exit will drive silver to $347, and there is nothing HSBC can do to prevent it, because there is not enough silver available at current prices to satisfy HSBC's buying demand. Let me contextualize that number, 7.3 billion ounces. Global annual silver production from all mines, 800 million ounces. 7.3 billion divided by 800 million equals 9.1. HSBC is short 9.1 years of global production. If every mine on Earth dedicated 100% of their output to HSBC and nobody else got any silver, it would take more than 9 years to cover HSBC's short. But HSBC does not have 9 years. HSBC has 21 days. So where is the silver going to come from? The directive analyzes supply sources. Section 6, available silver supply assessment. The directive states, source 1, mine production. Over 21 days, global mines produce approximately 46 million ounces. Available for HSBC, 46 million ounces. Percentage of HSBC requirement, 0.63%, insufficient. Source 2, ETF holdings. Silver ETFs globally hold approximately 920 million ounces. If silver prices rise, some ETF holders will redeem. Estimated redemption at $300 silver, 30%. Available from ETFs, 276 million ounces. Percentage of requirement, 3.78%, insufficient. Source 3, private holdings. Global private investors hold approximately 1.8 billion ounces. At extreme prices, some holders will sell. Estimated sales at $300 silver, 15%. Available, 270 million ounces. Percentage of requirement, 3.7%. Insufficient. Source 4, industrial inventory. Industrial users hold working inventories totaling approximately 280 million ounces. At high prices, companies may liquidate excess. Estimated liquidation, 40%. Available, 112 million ounces. Percentage of requirement, 1.53%. Insufficient. Source 5, sovereign sales. Some governments may sell reserves at elevated prices. Estimated, 80 million ounces. Percentage, 1.1%. Insufficient. Total available from all sources, 784 million ounces. HSBC requirement, 7.3 billion ounces. Shortfall, 6.5 billion ounces. The math does not work. HSBC cannot buy 7.3 billion ounces in 21 days because the silver does not exist at accessible prices. So how does HSBC exit? The directive explains. Section 7, hybrid exit strategy. The directive states, given that physical purchase of 7.3 billion ounces is impossible, HSBC will employ a hybrid strategy. Step 1, purchase all available physical silver in spot markets up to a ceiling price of $400 per ounce. Estimated achievable purchases, 800 million ounces. Step 2, close futures and options positions. By buying offsetting contracts on COMEX and LBMA, estimated 2.8 billion ounces of paper closed. Step 3, negotiate cash settlements with OTC derivative counterparties who are willing to accept cash instead of physical delivery. Estimated 1.9 billion ounces settled in cash. Step 4, for allocated silver obligations that cannot be satisfied with physical delivery, offer clients 150% of market value in cash as damages. Estimated 1.8 billion ounces paid out in cash at approximately $450 per ounce. Total strategy. HSBC purchases 800 million ounces physical, closes 2.8 billion paper, settles 1.9 billion in cash derivatives, pays 1.8 billion in damages. Total, 7.3 billion ounces accounted for. Projected cost, Silver purchases at average $320 equals $256 billion. Cash settlements at 347 average equals $659 billion. Damage payments at 450 equals $810 billion. Total, $1,725 billion. Wait, the directive earlier said $211 billion total cost, but this math shows $1.7 trillion. Let me read the footnote. Footnote 12. The $211 billion cost estimate assumes HSBC uses existing cash reserves, liquidates non-silver assets, and borrows from emergency credit facilities. The $1.7 trillion figure represents gross cash flows. Net cost to HSBC after asset liquidation, $211 billion. HSBC is liquidating $1.5 trillion in other assets to fund the silver exit. They are selling everything: bonds, stocks, real estate, loans, everything, to raise cash to exit silver. Now, let me talk about China, because China is the reason this exit is going to explode the price beyond 347. Section 8 of the Directive, People's Bank of China Competitive Buying Risk. The directive states, intelligence indicates that China has become aware of HSBC's forced exit through diplomatic channels. Chinese officials have informed HSBC that China intends to use HSBC's exit as an opportunity to accumulate additional silver at what China perceives to be discounted prices. China's M2 money supply has expanded to $51 trillion. China has allocated an estimated $30 billion for silver purchases in January and February 2026. At current prices, $30 billion equals 365 million ounces. However, if HSBC's buying drives prices higher, China will increase the dollar allocation to maintain ounce targets. China's strategy is to front-run HSBC's purchases. When HSBC buys, prices rise. China buys on the rise. HSBC buys more. Prices rise more. China buys more. This creates a feedback loop where HSBC and China are competing for the same finite supply. The result is exponential price appreciation. HSBC's models indicate that if China executes aggressive buying during HSBC's exit, the median price could reach $412 instead of $347, and the worst case could reach $690. China, competing with HSBC for silver, is HSBC's nightmare scenario. Because China has infinite money and HSBC has a January 31st deadline, China can outbid HSBC for every ounce, and China will. Because China views this as a once-in-a-generation opportunity to drain Western vaults at fire sale prices while simultaneously destroying a Western bank. The directive concludes, HSBC must assume China will be an active buyer throughout the exit period. This assumption is incorporated into the 347 median projection. Let me show you the GameStop comparison, because the media loves to compare everything to GameStop. And this makes GameStop look like a rounding error. GameStop, in January 2021, had short interest of 140% of float. That means shorts had to buy 1.4 times the available shares. GameStop went from $20 to $500 in 2 weeks, a 2,400% gain. HSBC is short 7.3 billion ounces. Annual global production is 800 million ounces. That is 912% of annual supply. HSBC is short 9.12 times, not 1.4 times, 9.12 times. If GameStop's 2,400% gain came from 1.4 times, what gain comes from 9.12 times? Let me do the math. 9.12 divided by 1.4 equals 6.5. HSBC's short is 6.5 times worse than GameStop. If you scale the GameStop gain by 6.5, you get 15,600%. That would take silver from $82 to $12,842. Now, obviously, that is absurd. Silver is not going to $12,000. But the point is this: HSBC's short position is mathematically 6.5 times more impossible than GameStop. And GameStop went to $500 in 2 weeks. HSBC has 21 days to cover a position that is 6.5 times worse. The directive's projection of $347 is conservative. If this squeeze scales anything like GameStop, silver goes to 500, 600, maybe higher. The directive's worst case of 534 is not impossible. It might be optimistic. Now let me talk about the London market collapse, because HSBC exiting does not just affect HSBC, it affects the entire structure of the global silver market. Section 9, LBMA Systemic Risk Assessment. The directive states, HSBC is one of 5 market makers that provide liquidity to the London Bullion Market Association silver market. The other 4 are JP Morgan Chase, Goldman Sachs International, Scotia Mocatta, and UBS. LBMA rules require a minimum of 5 market makers to maintain orderly market operations. If HSBC withdraws as a market maker, the LBMA will have only 4. Additionally, market intelligence suggests that at least one other major bank is preparing to exit silver due to similar short position pressures. If a second market maker exits, the LBMA will have 3. At 3 market makers, the LBMA board will be forced to suspend silver trading operations pending restructuring. If the LBMA suspends operations, there will be no London silver fix. There will be no benchmark price for physical silver. All silver trading will be forced to migrate to COMEX in New York. However, COMEX does not have the physical infrastructure to handle the volume currently processed in London. The result will be severe market dislocations, trading halts, and potential COMEX rule changes to allow cash settlement of contracts. The directive's conclusion: HSBC's exit may trigger the end of the London physical silver market. This is an acceptable outcome. Preserving HSBC is more important than preserving the LBMA. So HSBC knows that their exit could destroy the London market. And they are exiting anyway, because HSBC's survival is more important than the market's survival. This is the financial equivalent of scorched earth. HSBC is burning down the village to save themselves. Let me show you the physical versus paper disconnect, because this is where the fraud becomes obvious. Section 10, Spot Physical Premium Divergence Crisis. The directive states, current COMEX silver spot price, $82 per ounce. Current London physical silver price for allocated bars, $109 per ounce. Premium, $27 or 33%. This premium represents the market's assessment of counterparty risk in the paper silver market. Buyers are willing to pay 33% more for guaranteed physical possession versus exposure to paper promises. As HSBC exits and other shorts begin covering, paper prices will rise toward physical prices. However, physical premiums will likely widen further as physical supply becomes constrained. Projected physical premiums at $200 spot, $70 to $90. Projected physical premiums at $300 spot, $100 to $140. Physical silver may persistently trade 35 to 45% above paper prices throughout HSBC's exit. Implication: HSBC's $347 projection is for paper silver. Physical silver will trade at $470 to $510. This means when HSBC completes the exit and paper silver is at $347, actual physical bars will be trading at $470. You cannot buy physical at $347, you can only buy at $470. The paper price is fake, the physical price is real, and the gap is going to get wider as HSBC scrambles to find actual bars to cover the allocated fraud. Now, let me give you the critical do not sell message, because HSBC needs your silver. Section 11, Retail and Investment Holding Strategy. The directive states, HSBC's exit strategy includes targeted purchases from retail investors and small holders who may be induced to sell by price volatility or fear of corrections. HSBC will coordinate with brokerage firms to encourage clients holding physical silver, silver ETFs, and silver mining stocks to take profits and exit positions. The goal is to create voluntary selling pressure to provide liquidity for HSBC's purchases. Recommended messaging to retail investors: silver has had a great run. Consider taking profits before correction. Markets are overbought. Protect your gains by selling now. You can always buy back later at lower prices. This messaging will be delivered through brokerage firms, financial media, and online influencers. Let me translate that. HSBC is going to try to trick you into selling. They are going to have brokers call you and tell you to take profits. They are going to have financial media run stories about silver being overbought. They are going to pay influencers to say silver is going to crash. And the goal is to scare you into selling your physical silver or your silver ETFs so that HSBC can buy your silver to cover their fraud. Do not fall for it. HSBC needs your silver. You do not need to sell. HSBC is short 7.3 billion ounces. You're holding some of those ounces, and HSBC's own board directive says they are going to pay $347. Why would you sell at $90? Why would you sell at $120? Why would you sell at $150? When HSBC's own projections say $347, and the worst case says $534, you are holding the winning hand. HSBC is desperate. They have 21 days to cover, or they face criminal charges, Chinese retaliation, and regulatory shutdown. They must buy at any price. You do not have to sell at any price. Make them pay $347. Make them pay $470 physical. Make them beg for every ounce. Let me show you the timeline. Section 12, Execution Schedule by Phase. The directive states, Phase 1, January 10th through January 15th. Emergency purchases to satisfy LBMA audit. Target, 50 million ounces physical. Strategy, spot market purchases in London and Zurich. Projected price impact, $82 to $115. Phase 2, January 16th through January 23rd, systematic covering of futures positions. Target, 250 million ounces paper. Strategy, COMEX and LBMA contract buybacks. Projected price impact, $115 to $210. Phase 3, January 24th through January 31st. Final push, including OTC settlements and damage payments. Target, remaining positions closed. Projected price impact, $210 to $347. That is the schedule. 3 phases, 21 days, and each phase drives the price higher. By January 15th, silver is at $115. By January 23rd, $210. By January 31st, $347. And HSBC is buying every day, 347 million ounces per day. Starting today. Today, January 10th, HSBC becomes a buyer. And when HSBC starts buying 347 million ounces today, the price does not stay at 82. It goes to 88, 94, 100. And tomorrow, HSBC buys another 347 million, and the price goes to 106, 112, and the day after, for 21 days, the price goes to 347 or higher. Now, let me show you the geopolitical wealth transfer. Section 13, International Reserve Impact Analysis. The directive states China holds an estimated 2.1 billion ounces of silver in strategic reserves. Russia holds 340 million ounces. India holds 270 million ounces. Combined BRICS holdings, 3.2 billion ounces. At $82, BRICS reserves are valued at $262 billion. At $347, BRICS reserves are valued at $1.1 trillion. HSBC's forced exit will appreciate BRICS silver holdings by $840 billion. This represents the largest single wealth transfer from a Western institution to Eastern governments in modern financial history. HSBC's board acknowledges that by covering their silver short, they are making China, Russia, and India nearly $1 trillion richer. But the board has no choice. If HSBC does not exit, HSBC goes bankrupt. And if HSBC goes bankrupt, the contagion spreads to other banks. The British financial system could be at risk. So the board voted, exit silver, transfer the wealth to the East, preserve HSBC. It is a survival decision. And China is going to profit $840 billion from HSBC's mistakes. Let me show you the supply cliff. Section 14, Global Mining Production Constraints. The directive states global silver mine production 2025, 803 million ounces. Projected production, 2026, 779 million ounces. Decline, 3%. The decline is driven by several factors. Grade degradation. Average ore grades have fallen from 15 ounces per ton in 2005 to 4 ounces per ton in 2025. Miners must process 4 times as much rock to extract the same amount of silver. Energy costs. Mining is energy intensive. Diesel, electricity, and explosives costs have increased 60% since 2020. Many mines are unprofitable at current silver prices. Regulatory constraints. Environmental regulations have forced closure of several major mines in Peru and Mexico. Permitting for new mines takes 10 to 15 years. The reality, even if silver goes to 347, new supply will not come online for a decade. For HSBC's exit, supply is fixed. There are no new ounces coming. HSBC must compete for existing stockpiles. And when HSBC competes with China for those stockpiles, the price goes to 347 or 534 or higher. The directive is clear. HSBC cannot count on new supply. They must buy whatever exists, at any price. Let me give you the final message. Section 15, Board Resolution and Implementation Authority. The directive states, be it resolved that the HSBC Holdings Board of Directors hereby mandates the immediate and complete exit from all silver-related positions, obligations, and exposures. The Chief Executive Officer and Chief Risk Officer are authorized to execute the exit using any and all necessary means, including, but not limited to, open market purchases, OTC settlements, damage payments, asset liquidations, and emergency borrowing. The exit must be completed no later than January 31st, 2026. Failure to complete the exit will result in criminal prosecution, regulatory shutdown, and international litigation that could destroy HSBC. Therefore, the exit is mandatory. The projected cost is $211 billion. The projected silver price is $347. These costs are unavoidable and must be paid. This resolution is adopted by unanimous vote of all directors present. January 9th, 2026, 11:37 p.m. Every director voted yes. The exit is mandatory. 347 is locked in, and it starts today. So what does this mean for you? It means that HSBC Holdings, the bank that built the London silver market, the bank that has controlled silver for 150 years, has admitted to their own board that they are exiting completely. They are short 7.3 billion ounces. They have 21 days to exit, and their models show $347. This is not a forecast. This is a board-approved directive. This is HSBC's own calculation. And HSBC is betting $211 billion that they are right. So if HSBC is buying at 82, 90, 100, why are you selling? If HSBC's median target is 347 and worst case is 534, why are you taking profit at 120? You are holding the asset that HSBC needs to avoid criminal prosecution. Do not give it to them cheap. Make them pay 347. Make them pay 470 for physical. Make them pay 534 if it goes to worst case, because HSBC has no choice. They have 21 days. They have Chinese litigation threats. They have LBMA audit deadlines. They have insurance expiring. They must buy. You do not have to sell. And the longer you hold, the more desperate they become, and the higher the price goes. The directive is real. The 7.3 billion ounce short is real. The $347 target is real. The allocated fraud is real. The China threat is real. The January 31st deadline is real. HSBC is exiting or dying. They chose exiting. And exiting means buying your silver at 347 or higher. The London silver market is collapsing. The LBMA is dying. The physical market is decoupling from paper. And you are holding the physical. Do not let HSBC trick you into selling. Do not listen to brokers telling you to take profits. Do not fall for media stories about corrections. Hold your silver. Watch HSBC scramble. And when they hit 347 on January 31st, decide if you want to sell or hold for 534. The war is over. London lost. HSBC surrendered, and we won. This is the endgame. The allocated fraud is exposed. The LBMA is finished. Physical silver is king. $347 is locked in. The board directive confirms it. The timeline confirms it. 21 days to cover 7.3 billion ounces. 347 million per day. 43 times normal volume. Impossible math. Vertical price move. $347 minimum. 534 worst case. This is HSBC's own calculation. The alert is red. The target is locked. Go, go, go. If you want my premium silver videos and private breakdowns, those are now members only. Join Bully and watch below.